after remaining broadly stable over the last 1 month in the range between 75.50 to 75.80, the USD INR exchange rate breached the above range and touched an intraday high of 76.15 on Monday this week. The upside and downside movements in the global stocks gained the trend for the rupee dollar exchange rate. We have seen a significant recovery of over 32% in the benchmark Sensex from the low of 25,981 on 23/3/2020 till the opening level of 34,500 today. From the significant loss of 38% it suffered during the period 14th January 2020 to 23rd March 2020, the benchmark BSE Sensex recovered a major portion of its losses. Rupee's trend is set by the gains or losses in the global stock indices from time to time. The status on the coronavirus outbreak is not improving, and hence one can expect the global stocks to remain volatile in the coming weeks, and the domestic currencies gains or losses shall depend upon the performance of local stocks. We expect to see the rupee's range to remain within the 75.60 to 76.50 zone till the end of this month. The India-China border tension has triggered a sudden down move in the rupee exchange rate to test a low of 76.29 on Friday. However, rupee's support at 75.6080 level has now become the resistance level for the rupee. Till the border tensions are diffused, we don't see the rupee to recover beyond the 76.00 level, whereas a successful breach of 76.30 level would take the rupee to test the next support at 76.50 before the end of this month. By chance, if the border tensions escalate, we can see a knee-jerk reaction in the rupee exchange rate in the coming days. A violation of the weaker side of the 75.60 to 76.50 range can happen only due to geopolitical tensions and on evidence of second wave of virus outbreak in US and China, supported by portfolio inflows of about USD 2.5 billion in this month. Till date, the rupee held the support at 76.30 so far in the last week. The fall in global stocks in the last 1 week period is not reflected in the local stock indices. The lagging effect in the local stocks would get adjusted sometime in the near future. Amid falling returns in developed markets, the NRIs poured in almost USD 2 billion in their rupee accounts in April to enjoy the benefit of higher yield on their rupee investments after adjustment of rupee depreciation expected over a period of time. We expect the NRI remittances to increase over the coming months as most of the developed economies are offering negative interest rates on acceptance of foreign currency deposits. The forward dollar premia for maturities up to 3 months are trading lower and contained in the 3.30% to 3.45% per annum range. The surplus liquidity in the system is very much visible, and the short-term money market rates up to 6 months maturities are quoted significantly lower. The 3-month commercial paper is now quoted at close to 4.75% per annum for AAA rated entities, which is 75 basis points above the repo rate. The Indian interest rate curve is demonstrating a steepening pattern at the medium and long end.